Hi, everybody. Welcome. Thank you for joining us. We are having our participants come in. I just want to give everybody a second to get in their seats, turn on their volume, get yourself ready. We are excited this evening to have the second in our Sellinger Connect series from Loyola this evening. Our topic tonight is current issues and trends facing financial institutions and markets. I have Lisa Fairchild as our moderator for the evening. Thank you again for joining us, and I'm going to turn it over to her to introduce our guests.
Hi, everybody. I just want to echo Kristen's sentiments. I appreciate you attending. This promises to be a very engaging and enlightening discussion. We have two finance professionals here that are our panelists, and they have extensive careers in the areas of financial markets and financial institutions. So I think you'll enjoy very much hearing what they have to say. Let me introduce our guests to you. Our first is Callie Dirks. She's the managing director for global capital markets at Morgan Stanley in New York. And she's also the co-head of the firm's healthcare equity capital markets group. Since joining Morgan Stanley in 2006, she's held a number of other positions across the equity syndicate desk and also within the healthcare capital markets group. Callie is also a Loyola alum, and she earned her BBA in economics from us in 2006. And she's also a chartered financial analyst, otherwise known as a CFA. So that's a mark of distinction in the investments industry. Our second panelist is Ethan Heisler. Ethan founded the Bank Treasury newsletter, and he is currently its editor-in-chief. It's a monthly newsletter online. If you want to Google that, just the Bank Treasury newsletter, you can find it. And it's directed toward members of the financial institutions area in the Treasury area and also the CFO levels. The topics of the Bank Treasury newsletter focus on such issues as regulation, accounting, balance sheet analysis, investment portfolio strategy, asset liability management, and also just markets in general. Before he founded the Bank Treasury newsletter, Ethan was a managing director at Citigroup in the fixed income sales area, and he headed up Citibank's Treasury Resource Group. His prior experience also includes working at Salomon Brothers and serving as the staff director of bank analysis at the Federal Reserve Bank of New York. He began his Wall Street career at Dillon Read and Company on the government trading desk, covering regional banks for repurchase agreements. He earned his BA in philosophy from Columbia University, and he holds an MBA from NYU's Stern School of Business. So I want to thank both of our panelists.
And I'm a CFA.
And you're a CFA. Okay, I missed that. I'm sorry. So another distinguished CFA with us tonight. Sorry about that, Ethan. So thank you to both Callie and Ethan for being panelists tonight and supporting Sellinger Connect. So I also want to thank tonight's participants for submitting questions. Many of the questions were very similar in topic, and I have grouped them according to topic so that we can get through as many of your questions as possible. There's also an opportunity, if you think of something, to enter a follow-up question perhaps in the Q&A box. We'll be monitoring that as we go through the evening. So most of our questions tonight regarded the areas of regulation, deregulation, mergers and acquisitions, innovations and artificial intelligence, cryptocurrency, tariffs, and monetary policy. So to get started, I'm going to ask each of our panelists a general question. And as our webinar proceeds, we're going to get into more specific topics. So also for each of our panelists, if you have follow-on thoughts after the other panelist has answered, feel free to add your comments. So I think we're going to have a very rich discussion here. So Callie, let me start with you. Are there any specific market trends happening or have happened as a result of the 2024 election? And how would you see these trends affecting your sector, which is healthcare?
Sure. No, thanks, Lisa, for having me, and happy to take that. So as Lisa mentioned, I co-head healthcare equity capital markets here at Morgan Stanley, which means I work on taking companies public via IPOs and raise follow-on capital for companies that are already public. Also work with companies on raising private capital, and that spans healthcare companies across the board, in biotech, in services, in health tech, med tech, diagnostics, and the like. So some of the themes maybe coming out of the 2024 election for us within healthcare right now has been deregulation. A big part of our market includes M&A, and with the current establishment previously, there wasn't as much large M&A within healthcare. Also saw that in tech. And so as we've started to see the new administration come in, there's been a view that there'll be deregulation. There'll be more ability for larger M&A transactions, as well as kind of less scrutiny on some of the overlap that we've seen. This really affects us in particular because a lot of the large pharma companies will have pretty significant patent cliffs that are coming up in the near term, in the 2030s. And a lot of what they do on the M&A front is almost like outsourced R&D. They buy companies early. Lilly is going to buy companies to fill their GLP-1 hole one day. Merck is doing the same, as is Pfizer and others. And so one big trend has been this deregulation. And we saw it actually early in January with J&J buying a company called Intracellular for $15 billion. Just as an example, that was a really large transaction. We hadn't had anything of that size really since the early part of 24. The other thing that really affects our industry is rates. Healthcare is typically a user of capital, especially the therapeutics arena, where capital is needed to run clinical trials. And so where rates are right now, being much higher than they were during the pandemic, has definitely dampened or made the hurdle much higher for companies to be able to access capital. So we're seeing an impact on the IPO market, on the follow-on market, and kind of on equity volumes more broadly, as rates continue to stay somewhat elevated. But those are really the two big themes that I've seen, both deregulation and the cost of capital kind of tightening the healthcare market a bit.
Right. So Ethan, I'm going to continue on this topic here of just some general trends. What do you see for financial institutions? Any particular trends after the election that kind of just jump out at you?
Well, honestly, I think we'll continue to see more of the same. Like, let's set the overall tone. The U.S. economy continues to remain very strong. There are no signs that the U.S. economy is about to fall off of a cliff, as many people were quite concerned just a couple of years ago when the Fed raised interest rates to the overnight rate from 5.25, 5.5, from effectively zero in a matter of about a year and a couple of months. That level, that magnitude, failed to dent the economy at all, and in fact, we're really after 100 basis points of cuts in the last in the fall, and sorry, in the winter. Some of us are actually thinking there could be even a rate cut in the next year. So I think the overall background will continue of one of uncertainty. I don't think we're going to get any clarity. Throw in the more, I think, newsworthy than actually effective tariffs, which, while they are signed to great fanfare in the news, and that's a big part of the news cycle, when they actually get implemented will be a different matter, and how long they're actually implemented for will be a different matter. We'll see. But all of this aside, I mean, all of this creates that same level of uncertainty we've seen. The banks have reported very low loan demand, even though they've created more of a pipeline through loan commitments. And they've talked about that just recently on some of the industry conferences. We've still not seen anything in the H8 data to suggest that loan growth is picking up, and that would have been long expected. So I think that continues. And we're sitting with a very flat yield curve. We've been inverted for up until just recently, but now we're sitting with a very flat yield curve that's essentially saying that the Fed may be done on rate cuts altogether. Um, I think that there's a lot of uncertainty around just where rates are going or how they go. That will be a big part of the story.
Okay, let's continue on this topic of regulation that has been mentioned by both of you. And Ethan, let me direct the next question to you. Because in the US, we have a lot of regulators for financial institutions and markets.
Mhm.
There's been a lot of talk with the Trump administration of perhaps consolidating regulators and perhaps eliminating the FDIC again. That's according to the media, so we have to kind of put that in context. Uh, what are your thoughts on the possible consolidation of regulators? Is this good? Is it bad? Um, which ones do you think, if any, could be consolidated or eliminated?
Mhm. Well, first, I need to caution, as I mentioned to you earlier, the discussions around FDIC being consolidated within Treasury relates to its supervisory powers. As far as we know, the Deposit Insurance Fund, which insures deposits up to 250,000, will continue. If anything, there is demand, and there has been growing demand, that the FDIC should raise that actual deposit limit, which they just raised, as you remember, just during the financial crisis. So that is a topic under discussion regardless. I think that um, the other question is, if my biggest fear, let me back up. So you mentioned I was at Citigroup. And you mentioned I started at Solomon Brothers. So I started at Solomon Brothers and we consolidated into Citigroup. Let me tell you about being at Citigroup. Um, we were still basically Solomon Brothers in Citigroup. So they were still basically just tribes, and the culture doesn't mesh. And things, even if you put companies together, you have rails that connect the company. And when those rails are not addressed, you get, well, I mean, Citigroup nearly failed during the financial crisis. A lot of that has to do with what was done earlier in the day. And I use that for me in thinking about, oh, you want to consolidate an agency with all these examiners, and you want to shove those examiners with other examiners who probably don't regulate the same institutions anyway. Or you want to get rid of the FDIC examiners, and you just want new examiners to come up with these institutions that they're not familiar with. Think about what's so important to people today is community banking. It's a hot topic. And I think getting rid of the regulator that's actually most focused on these community banks is not going to be very good for them, I would think. So those are my initial thoughts.
Right. So just building on this notion here with community banks, do you foresee perhaps with deregulation, consolidation just within, the banks themselves, that the community banks get bought out by the larger, say, super regionals or the money center banks?
Well, I don't think the money center banks will be buying community banks anytime soon, but I think of them as gathering snowballs. You get these small little banks. I remember Umpqua Bank 20 years ago was a $4 billion bank in Portland. Today, they're Columbia Bank, and they're about 50, $60 billion more. I've known lots of stories like this. So those kinds of institutions, that kind of consolidation will definitely continue. And I think probably will gather steam because a lot of these smaller community banks don't have the resources, and their management team is looking for a way out. The market is really hot for these banks. And in the parlance of Wall Street, I buy low and sell high. I could see a lot of sellers. The question is, how many buyers are coming in? There's a lot of money coming right now into banks, which many banks are using to reposition their balance sheets. But the rest of them is looking for a home. And it demonstrates to me that there's a lot of cash in the system right now. So when you ask me, will there be consolidation? Oh, yes. And I also think among mid-sized institutions, we will see consolidation.
Allie, let me ask you about in the healthcare sector with this notion of deregulation under the Trump administration. How well do you think the healthcare sector is going to fare? It sounds like from your earlier comments, you're pretty optimistic.
Yeah, I think, look, again, healthcare is a user of capital, and M&A provides both innovation to large pharma, and it recycles capital amongst the investor group. Right? If a small public company gets bought by a large pharma company, then that cash that the pharma company is paying gets dropped down to the smaller company holders. And they then have the capital to reinvest. So I think that's a critical part to the virtuous cycle of healthcare innovation, especially when you think about therapeutics and the progression of getting really transformational drugs to patients. The reality is the commercial sales force, the infrastructure to launch a drug, a lot of that belongs within large pharma. And so you kind of have to have this recycling of capital, this M&A cycle to be able to take really innovative drugs and then put them in the hands of people that can actually, launch it, deploy it, get it to patients. And that's not just in obesity, but it's, in oncology, it's in cell therapy, it's in autoimmune, which is also a really interesting area with a lot of innovation. So I am optimistic. Again, I think, rates is on the other side. That kind of, makes it difficult. But the need to, bring solutions to patients that are suffering, it will continue. And the biotech industry has had, I think some reasonably large successes, over the last couple of years. That should continue. We haven't seen, I think, this level of progress on the scientific side, in a long time. There's a lot more precision, a lot more biomarkers and things like that help companies know if they should progress a drug further. It's not as much of a binary, risk of failure or success, right? They know a lot more and are able to de-risk these trials as they get further along. And that also can give pharma more confidence in, paying for the asset to bring it in-house and ultimately, hopefully launch these drugs for people.
All right, just as a follow-up, in recent years, we've seen a lot of vertical integration, and for who joined us and aren't familiar with that term, that's when one large company owns various parts of the supply chain. And I'll give everyone an example here. We're all familiar with CVS. We see these drugstores everywhere. But what a lot of people may not know is that the CVS drugstores are part of a big company called CVS Health. And CVS Health owns Aetna Insurance, which a lot of people have health insurance through Aetna. They also own a pharmacy benefits manager called CVS Caremark, which helps set drug pricing with not only Aetna, but with other insurers too, such as Care First. So we've seen a lot of those big conglomerates form through vertical integration, and we see various pieces of the healthcare system now all under one umbrella. Do you think that's going to continue?
Yes, I do think that'll continue. And look, it'll continue because, to your point or example on CVS, being both a manufacturer of products, having your own brand line of products, and then being able to distribute it, and then also being able to serve the customers that come into those stores with pharmacy benefits or insurance. Like, there's a lot of synergies with that. So I do think that it will continue, and it is certainly a theme within healthcare, because what we want to ultimately shift to is more value-based care, preventative care, right? Have a health system that's actually helping prevent you from being in the hospital. And so that theme, I think will continue. And I know we're going to talk a little bit about, private equity and things like that, but there is definitely an interplay with the financial institutions in terms of how they are trying to create those more vertically integrated models, especially when in care systems that are highly, highly fragmented.
Yeah, and I was getting ready to just ask you another question here about private equity. We've seen a lot of just medical practices, perhaps purchased by private equity groups, and they take this, then national. I mean, say your orthopedist group or your dermatology group becomes part of a larger national network. It sounds like you think that's going to continue also. This,
Yeah, I think it's going to continue in places like dental, physical therapy, women's health, especially places like, take physical therapy as an example, where a big part of the issue with physical therapy is not the demand, but the practitioners that are qualified and like people that are able to operate these physical therapy offices. And so how do you maybe get some synergy and scale with your employment force, or how do you train them, to be able to have a benchmark of outcomes? And so I think there is an institutionalizing that these, private equity firms are trying to put in place. And physical therapy is one place where, again, it kind of fits into that theme of, preventative care, versus going in to have shoulder surgery, doing the physical therapy ahead of time. But I think you will see more of that in these large places where we're chronic users, right? Where we go to the dentist all the time, we might have to go to the physical therapist all the time. And then the other thing that they're going to layer on is, how do we do this remotely? How do we leverage technology enabled to do that? Can I do my physical therapy over Zoom, where the PT is showing me how to do it, and, try to bring it to more people, more effective, fitting into your daily life more. But private equity has a fair amount of capital, and they are definitely looking across the healthcare space and how they can apply synergies to these large, thematic areas.
okay. While we're on that, well, you mentioned technology here. Let's talk about artificial intelligence. It's everywhere. We saw last week, DeepSeek introduced by this Chinese company. It's produced now much more cheaply than, Chat GPT. So let's talk about how artificial intelligence may be affecting your areas of expertise. So Ethan, let me start with you. What role do you see, if any, of AI and other tech innovations in the banking industry? Do you see it leading to increased profitability or some sort of other effects?
Well, I think AI is already making its impact in fraud detection and other consumer interface applications. Like, you call up the bank to report a card stolen, or something along that lines, or you need a new card, and you'll interface with an AI. It cuts down the amount of staffing that you have, and so I think there's that function that's already been established that will get better. It will also help it's already being used in terms of lead creation for account officers. Where I think its new applications will come will be in areas like, for example, risk management. So it's helpful as a decision planner. Um, I liken it to, in the past, I would have to hire like a team of 1,000 analysts to crunch out all the potential scenarios where I could potentially get into trouble. And instead of doing that, I'm able to press a button and within a few seconds be able to identify where are my greatest risk factors that I need to worry about. Or for another example, I come into work and I think I have 5 priorities I have to address. There's a priority 1, 2, 3, 4, 5. AI will help in identifying what the one is in that list. And I think that's pretty significant for for the for the banking industry. Beyond that, I would imagine that a lot of functions currently where you have human beings doing them and just basically doing the same thing will be taken over by artificial intelligence. I mean, I can see that as institutions look to reduce costs and expenses.
Well,
So,
that's
I mean, I would say sky's the limit. It really all depends. The one other thing I would add, and I think this is something I've encountered as I've discussed AI applications with institutions, is when you buy an exercise bike, it could be a great way to lose weight or get exercise. It could also be an expensive coat hanger. And I think for a lot of institutions, there's a lot of challenges. Who's going to actually use this? How they're going to use this? And defining the applications. Well, this is a great tool. What is the problem it solves? Is I think a key thing that institutions, the key barrier I would say that the institutions have when they think about, okay, I'm going to spend a lot of money and invest in this thing.
right. You mentioned risk management. Uh, what do you think the biggest risks are facing financial institutions right now? I see lots of talk about climate risk. I see cyber security, cyber attacks. I see, perhaps even AI itself as being a risk. I mean, what do you think?
Well, I think cyber risk is always out there. Nobody can really measure what that is. I mean, that's kind of those wild card things. Sure, I mean, we could have a major outage. It could cause great deal of instability. I think the risk. We always talk about the risk to the financial industry is commercial real estate risk. So a year ago, when New York Community Bank was getting into trouble, there was a lot of concern around commercial real estate and specifically around office. A lot of this stuff is stuff you see. I think financial institutions have learned that it's the stuff that you're really not looking at or thinking of the way that it's an issue that really can end up biting you. And Silicon Valley Bank is the perfect example of that. I mean, an institution that's sitting on 65% of treasuries and government guaranteed mortgage backed securities blows up and fails almost overnight. That's unheard of. Depositors leaving the bank en masse. I'm worried about other institutions seeing the same kinds of things. All overnight, when the industry is strong capital, when the asset quality is low, when all the conventional risk things that you normally look at were fine, that teaches you that risk comes from wherever it comes from. Banks just need to be prepared. They sit on a lot of capital. They were going to sit on more capital. It looks like that's not going to happen right now until the next blow up happens, in which case banks are equally hated by both sides of the political aisle and will be forced to raise capital, I'm sure. Um, and they're sitting on more liquidity than they've ever had. That's been tested. I mean, I think things like what the Fed has done with LISIC, which is just looks at large institutions, subjects them to an extreme scenario stress analysis stuff. That's the good stuff. So I think in that sense they're safe. I think yeah, cyber risk, I would say the uncertainty in the economy can go ahead and certainly fail. That's a big issue. Um, the Fed loses credibility over monetary policy, basically by cutting interest rates by 100 basis points and then suddenly talking about potentially we could see a rate hike. I mean, that kind of thing could definitely hurt, or missing inflation entirely and keeping rates too low too long. Those kinds of things, if somebody thinks the Fed's really not there. But so far, when we've had a crisis like in March of 2023, the Fed stepped in with something like bank term funding, the bank BTFP. that definitely, and guarantees on Silicon Valley and Signature that really helped to allay everybody's concerns. So I think the Fed as a lender of last resort remains a critical component of the stability of our financial system. And you mentioned the FDIC, so I think that as well.
Right. Callie, you mentioned a few minutes ago, a number of innovations, or at least in general, you see a lot of innovations taking place in the healthcare industries. Are these things positively impacting value, or have we yet seen, the value creation there for a lot of these innovations?
I think they are positively impacting value because they're allowing for a platform of technology. They're allowing for different modalities to emerge that can be applied across various indications, whether it's in oncology or it's in autoimmune disease. And so I think it has created a lot of value. Maybe to the question on AI, and its impact in healthcare, it is an evolution in healthcare. It is not an overnight revolution. There is certainly a lot of work that AI can do to streamline, especially when you think about, how companies pick a dose and do dose finding studies, leveraging AI to understand the dynamics of dose, is one example. So another example is using AI to find like specific targets and how to drug them, specific genetic mutations that maybe were seen as undruggable, but using AI to really synthesize and see how, we could affect different proteins and targets. So, but we haven't seen a drug get approved that was created or found through AI yet. So I think there's still a fair amount of time. But there are certainly a number of companies out there that are streamlining, and they're not taking the people away, I think, from the process, but allowing them to do a lot more, a lot faster than ever before. But I do think it's more of an evolution, especially within biotech, within therapeutics, than an overnight, change or success just yet. But hopefully that that changes in the next 5 years. I mean, it's come a long way in the last 5 years. So
Okay. While we're on the topic of technology and innovation, let's move into cryptocurrency. I know this is a really hot topic. A lot of people think it's great. There are other people that think it's, I've heard it likened to a pet rock. So we've got, lots of different opinions about, cryptocurrency. But if you look at what's happening now with the Trump administration, and, things are happening very quickly. I think, one of the commentators I saw yesterday that characterized this as like the fastest moving transition probably in presidential history. If you just look at the number of executive orders, then just getting, the cabinet members chosen and trying to push them through the confirmation process quickly. And there's already targeted areas of the government to consolidate and perhaps even shut down. We saw, late last night, Department of Education had been rumored as, a target. Well, official announcement, let's get rid of Department of Ed. But cryptocurrency is another thing that's, seems to be on the radar of this administration. And if you look at Paul Atkins, who is the nominee for the chair of the Securities and Exchange Commission, he has strong ties to Token Alliance. And that's a cryptocurrency advocacy group. So Ethan, how likely do you think it is that cryptocurrencies will go mainstream as a form of payment?
Very little.
Oh, interesting.
Absolutely. I don't think anybody really needs it. People use credit cards in this country. It's the main form of payment. The Fed does an annual study. Credit cards have actually grown, and debit cards to a degree, but mostly credit cards. Cash, I mean, cryptocurrency, why would you want cryptocurrency when you can have the US dollar? I can't see it. Unless, of course, Congress doesn't pass the debt ceiling, then we all have issues. But assuming that doesn't happen, people trust in the US dollar because it's the US dollar. So if you're in countries that are really poor, like Russia, or crazy, like Russia, or you're in El Salvador, which is a big user, ditch and converted their currency to Bitcoin, maybe you want to have Bitcoin. I don't know. Or you're a drug dealer, you want Bitcoin. But I don't really know who's investing in Bitcoin. That's an investment because of Bitcoin. Like, what's the Bitcoin argument? Bitcoin, I kind of think is interesting only because there's a limited amount of Bitcoin, and it takes a limited amount. It takes a maximum more energy to produce every extra Bitcoin. So there seems to be some economics involved in its valuation. I can kind of see that. But it tends to be dominated by a few key investors, not a kind of thing that you really want to use as an investment. I used to have arguments with the guy who manages my IRA account. I was trying to say to him, maybe I should include some Bitcoin as a counter to gold or something like that, as an inflation hedge or whatever. And he always said, take a look. And you know what? As an inflation hedge, Bitcoin hasn't been any better than buying gold. It really hasn't. I think, a few years ago, people were buying stable coins as a way station for investing in crypto. But it all comes back to, what are you using crypto for? In retail payments, don't see it. The Fed also launched Fed Now. You can go and look on the stats. It was basically in July of 2023. And it's if you look at it, the basic payments on that are there's been a number of institutions that, like, over, I think, about 2,000 institutions that have signed up so far for it. And the average transaction on a daily basis is something like about $250 million. So, it's starting to really take off. But if you compare that to the amount of payments that goes on a daily basis, like, I think it's around 3 trillion, it's really, really, really small. So I really think crypto is not worth the hype, my opinion. The Fed also did look into the CFPB, not the CFPB, the central bank digital currency. They basically shelved the project about 2 years ago because, again, we don't need the central bank digital currency. I already can make instant payments if I want, as a consumer, through Zelle. It's Fed now sells it for credit unions and small community banks, and they can level the playing field with the larger institutions to be able to offer their customers instantaneous payment. So, I really, to the degree that instant payment is definitely taking off, that's definitely a trend. We are seeing that. And there's some interesting Fed studies to show that. It still doesn't take the place of, I'll give you another example. You know that there's $2.4 trillion of currency in circulation, just the paper money in your wallet. Do you know who holds half of it is outside of the United States? So think drug lords. That's how our money gets created. A central bank digital currency, which is what the Fed was saying, which would be just as good as the paper money in your wallet. The Fed looked into this, and the one biggest problem that they could not do was provide you with anonymity. The Fed, the executive order came out a couple of weeks ago, basically decayed the whole project. But the Fed had already realized that nobody would want a central bank digital currency where you couldn't preserve anonymity. And they couldn't do that because of drug trafficking and terrorism. So my basic whole thing is, I think this is a lot of headlines, but I think the whole crypto craze, somebody's valuing, and a lot of people are going to lose a lot of money.
But do you see value in the blockchain technology?
Oh, yes. We're seeing it in repo, for example. That's going to be a big application. If I can instantaneously settle my repo transactions, you take huge risk out of the financial system. Huge. Absolutely. Blockchain will be a big one. Tokenization in general, where you can take an asset like what you do today with a securitization, and tokenize it. That gives lots of applications. It's really exciting. So yes, absolutely.
Okay. Do you have any comments on crypto? Any thoughts?
Not really. No, I'm not as familiar as Ethan, to be honest.
I've
I know.
deep dived into this over the years because obviously this is a huge topic.
Yeah, yeah. I agree on the blockchain point, though. I agree with that very much.
Yeah, well, crypto is something that I know when I teach investments, I always have a handful of students that are really enthusiastic about crypto. And remember, I guess it was about 10 years ago, I had a couple of students who had actually bought Bitcoin. They were in my MBA class. And I don't know if they held it, but if they did, they have done quite well.
When
So
did they buy it?
10 years ago,
Which,
20,
how many?
it was in my MBA class. They bought like a couple of Bitcoins each when it was,
5 years ago.
oh, 10.
10. Oh, good time to possibly own it. It was around 12, 13.
Yep. It was
Mhm.
pretty, and I was thought, I was kind of skeptical like everybody else. So I didn't dabble in Bitcoin, still haven't. And then I had a bunch of students that got into the uh, NFTs, the non-fungible tokens, which,
Mhm.
Bored Ape Yacht Club, and that really did seem like pit rocks.
It's
So
like investing in baseball cards. Who does that?
I mean, there's a preference
You
for
got to
that.
know what you're doing. And NFTs, somebody owns that. Again, weird markets. And SEC is not really involved. That's one thing people really object to Gensler. But one thing he really was focused on was this whole idea around the crypto market and lack of regulation and disclosure for the average investor. I think that that's really critical. It should be a bipartisan support because if it blows up, everyone's going to pay.
Yep. And there's going to be a day of reckoning at some point.
Hmm?
There always is. So, all right. Interesting thoughts of crypto. Let's talk about tariffs. We mentioned them a little bit earlier. Uh, I'm going to start with Callie on this one about generic medication, because most generic medication is made outside the US, for example, in India, Canada, Mexico, parts of Europe, China. Um, what do you think about Trump's tariffs and, the impact on the healthcare industry?
Yeah, it's a good question. It's definitely incredibly topical. You see a lot of manufacturers, having to address it in recent earnings calls. Um, they're really addressing it pretty broadly, because they don't know the extent of it. The way I think a lot of them are trying to handle it is, in the last Trump administration, what did we do and what do we still have in place? The other way that they're thinking about it is, how do they shift manufacturing? Am I going to take something from China to Malaysia or the Philippines, and what is the speed at which I can do that, and do I have those relationships, and how much of my costs are in China? So it's definitely quite topical. I would say mainly for the manufacturers, but it's different this time around in that they have the experience from the prior administration. And look, they're still going to continue to create to manufacture something in China regardless of tariff, because it might still be cheaper to do it there. But I think what we have to you have to evaluate is, there might be some earnings volatility as they navigate that, but it's very much front and center in the healthcare industry right now. It's definitely quite topical, but there's just not a lot of no one can really give discrete guidance as to how it's going to affect them just yet.
Yeah, this is one of those things that I think people are waiting to see who blinks first. And just to see, we've already seen, Mexico and Canada kind of, fold, or at least we've deferred tariffs for 30 days, based on talks with the leaders of those countries. China doesn't seem to be backing down. In fact, they countered. So I think it's going to be interesting just to see what this whole process looks like. And there's lots of people that say that, well, this is just the starting point for negotiations, that these aren't going to last that long. Other people are a little more pessimistic and think, no, this basically means a line in the sand. And, it could be pretty serious. And on that note, let me turn to Ethan.
Oh, could I ask a quick question of Callie? Is it all right? Can I
Yeah, of
ask you a
course,
question
please.
about, okay, so there's an article today in the FT around the weight loss drugs and the
Hmm.
tariff.
Hmm.
So how elastic do you think domestic demand is for that stuff if it's actually all passed on to the consumer?
I think demand is very inelastic. I think people will continue to pay for those. Yeah,
Interesting.
I think people will
Me
continue to
too.
pay
I
for
think
those
so
drugs.
also.
I think the biggest thing that I'm seeing in the therapeutics landscape is development of drugs that are going to be muscle sparing. There's a lot of concern that, a lot of these, you lose weight, but you lose a lot of muscle. And
Mhm.
obviously the weight of muscle is more than fat. And so if you lose muscle and then you put, weight back on, you might put that back on as fat, right? And not replace the muscle. So I think there's a lot going on to how do we have more muscle sparing drugs that are either, alongside, these weight
Very
loss
interesting.
drugs. How do we have them as oral versus, injectable? But there's a lot of development focused on obesity, and not just from losing weight, but also the other effects: cardiovascular, CNS, the inflammation in the body. How does that affect your skin, and like, things in, autoimmune and like, skin disorders. There's also a lot of innovation coming out of China and Asia, and so, there's a lot of to come from large pharma this year, but there's a very fair amount of innovation to how do you administer it in a more easy fashion for people, and also how do you spare their muscle as, they're losing weight, so that they can get the benefit of, all these other things other than just weight loss, but they're not losing muscle that way. I mean, as I spent a lot of time in this industry, I think muscle is the key to longevity. It's really important to have lean muscle, and so, the loss of that is hard,
Right.
and has to be, pretty carefully monitored.
But the customer is being pushed along by their doctors who are basically saying, go on this stuff.
I mean, or they're buying it, compounded, right? And so that's a big
Interesting.
topic right now too, especially as you see like Super Bowl ads and whatnot. So
Right. Thank you. Sorry.
yeah, no, it's a great, it's a great topic.
An interesting world, let's put it that way. So on this topic of tariffs, and I was getting ready to ask Ethan, a lot of people think they're going to be inflationary. Given the link between interest rates and inflation, the basic Fisher equation. Do you think commercial banks will be harmed or helped by tariffs, or do you think it's a matter of duration, as you alluded to earlier?
Well, first off, let me say I'm of the view that interest rates have nothing to do with inflation in this economy that we're in since COVID began and the stimulus was created. So the federal government through fiscal stimulus created $5.5 trillion of COVID stimulus money. That money is still in the financial system, it's still circulating around. I liken it to the amount of money that was spent to fight World War II that lifted the United States out of the Great Depression and also onto a 25-year economic boom. So think of the US economy basically on jet fuel. So I think the Fed has been struggling all along with how high can I actually raise rates without destroying the banking system's fixed rate loans and fixed rate assets that they own, and decapitalizing the banks, and also rein in inflation. We had the answer is that they really were unsuccessful. Now we still have a prevalence of inflation, notwithstanding the PPI number this morning. I think the tariffs, if they do go into effect, and I still am of the view and very skeptical that they ultimately actually happen and that things are not amended along the way, what we're not looking at, but they get the headlines that they were intended to get. But I think these tariffs will pass along to the American consumer a lot of expenses, the Wegovy and the Mounjaro notwithstanding. And the American consumer will eat it because the demand for most of this stuff is really not discretionary. I need the food, I need the clothes, I need the house, I need the car insurance, I need the medical care, I need all these things. So, I'm going to continue to pay for it. And I don't know how long that's going to last, but right for now, I see that as having, if they go to effect, they're going to affect inflation, and they're going to complicate what already was a very complicated process the Fed is addressing to rein in the inflationary effects of $5.5 trillion of fiscal stimulus. That's my answer.
Do you think the Fed has any tools left in its toolbox to do that?
The Fed's only tool is to lower or raise the reverse repo rate and the interest on reserve balances, because they follow an abundant reserve policy, which means that there's more reserves in actual demand. So supply and demand laws means that the rate actually could fall to zero if not for the rate that the Fed sets with the interest on reserve balance and the RRP. Again, the Fed's kind of limited in what they can do. If they lower the front end of the yield curve, the back end of the yield curve will follow what the back end of the yield curve. Either they believe that the Fed is fighting inflation, or they believe that the Fed is giving up. What we just saw in the last cycle was that they showed that the Fed is giving up. That's pretty much what happened. First time in 40 years that the back end of the yield curve went up when the front end went down.
Okay. Anyone participating have any questions, follow-ons that you want to add to the Q&A box? If so, please type your questions.
It's hard to ask questions.
Yeah, questions
It's
are good.
just so much that's going on. Every day you feel like you're drinking from a fire hose. I'm still always stunned every day I open the newspaper.
You almost dread to open it, right? I know every morning it's like, oh my, what's happened now? What's next?
But we were focusing on weather here in Long Island.
No questions? All right, let me ask our panelists if they have any final thoughts they want to impart. Anybody have final thoughts here?
I don't know. I'm trying to think of the theme here. I mean, I'm glad that Loyal is doing this. I think getting into the alumni network is really critical. So I appreciate you guys putting this together, and very proud to be an alumni. So appreciate you guys doing this and kind of keeping things really relevant. So thanks for organizing.
And on my end, I also really want to thank the university for allowing me to participate, since I'm not an alumni. But it's really great to have this interaction. I want to open up that if anybody wants to get my newsletter, you can email me at ethan.heisler@thebanktreasurynewsletter.com. It's this newsletter that I invented when I was at Citigroup 20 years ago, because I was an II published research analyst. And when I went over to markets, they wouldn't let me write research anymore. So I called it the newsletter, and the compliance people were just fine with it. So I've been writing it for like 20 years. It's Ethan's blog of talking to treasurers and CFOs about stuff that's actually unrelated to credit, but it's really all the stuff that they end up talking about, and learning about boards of directors and how they end in the interactions. I've become a big believer that you could talk about all these regulations, and you could talk about all the economy, but ultimately every company depends on the people that work there and how much they really care about the institution. Now, again, working at Citigroup and watching the people, one CEO after another, screw the institution up, it really matters who that smart person is that you can get. That's what I think that's really the hard work of trying to analyze these companies and try to understand what makes them tick. Got to know who the people are. So that's my words of wisdom.
Well, thank you, everyone. And hope you've enjoyed this. I found it very enlightening, and a big thanks to our panelists, Ethan and Callie. And, that's event services, never mind. But this has been great. So thank you for taking time out of your busy schedules to participate. We appreciate it very much.
Thank you so much,
everyone.
everybody.
Thank you.